Hi and welcome. I'm delighted to have this opportunity to talk to you about the exciting and fast developing field of FinTech, a fusion of financial services, data science and communications technology. The term FinTech is relatively new, and whilst most will have heard of it, many would understandably ask what it means or stands for. Given this, a good starting point for our discussion would be to provide a definition of FinTech. And this is my definition, a working definition. FinTech is the innovative use of technology to enhance procedures for transferring, raising and investing money and capital. Later I will define another term, one we are encountering increasingly in this space, TechFin. Collectively, FinTech and TechFin span what we may think of as modern finance. Now, from the definition of FinTech, it is clear that it represents some form of hybrid of finance and technology, and that is a good place to start. The financial services sector has always been at the forefront of technological innovation and has used technology frequently to disrupt and come up with new and better ways of doing things. This started a long time ago, from the dawn of civilization really. From the use of gold nuggets or basic coins as a store of value in the age of barter, to the introduction of paper money in the age of coins. Paper money first appeared in the British Isles a little over 300 years ago, Scotland being the first of the UK nations to adopt it, and that was before the UK was formed in fact. There are, however, records of paper money being used in China almost 1,000 years before it first appeared here. Then we had cheques start to appear in the age of paper money, and indeed they have been around for approximately 300 years and are a UK creation. Next came credit cards in the age of cheques. These first appeared in the UK in the mid-60s, with Barclays the first to introduce them. They had originated as charge cards in the form of the Diners Club card in the United States in the 1950s, and would soon evolve into credit cards and subsequently into the Visa, MasterCard, American Express networks we know today. The first ever Diners Club transaction took place in a restaurant in New York in February 1950, in an event that within the financial services industry became known as the First Supper. Then there arrived ATMs, or automated teller machines, in the age of human bank tellers. ATMs, or cash points, have been around for more than 50 years, and indeed Barclays Bank in Enfield, England in 1967 unveiled the world's first ATM. Certainly a world's first in the form we currently recognise as an ATM. We have witnessed the emergence of online trading in the age of stock market traders and brokers. This development mirrored increasingly accessible and affordable computing power, together with the boom in programming and software development and the World Wide Web. Innovation has really accelerated in recent years to include the appearance of digital wallets in the age of leather wallets, cryptocurrency in the age of fiat currency, decentralized blockchain ledgers running on public networks in the age of private centralized bank servers and databases, robot financial advisors in the age of human financial advisors. The list goes on, clearly demonstrating the inextricable link between finance and technology, a link that spans the ages. Now, in order to provide some structure to our understanding of FinTech, a useful starting point is to identify a range of financial services which we encounter in everyday life. The financial services industry is a very broad church, covering a dizzying array of products, processes and services. However, we can get a good feel for its core activities by looking at the banking sector. Most things that go on in financial services are in one way or another connected to banks and banking, and banks are things we are familiar with. Banks offer and maintain accounts, all kinds of accounts, from basic bank accounts to current accounts to business and deposit accounts. They store our money with trust. Well, by and large they do. Though the irony should not be lost on us that it was through not always storing our money with trust that brought about the global financial crisis in 2007 and 2008, the single most influential event in the emergence of FinTech. The banking system is instrumental in overseeing payments of all sorts, whether in cash, cheque, debit card, credit card, drafts, standing orders, direct debits, across gifts, donations, retail, household bills, salaries, pensions, benefits, and more. When we need to raise money, say to make a purchase, to refinance debt, or to fund a project, banks are often the first place we go. Whether that be for an overdraft, a personal loan, a credit card, a mortgage, banks offer the full range of lending services to their personal customers. And there exists the equivalent for commercial enterprise, an even more extensive list of lending and related services to businesses of all shapes and sizes, including on the debt side, issuing corporate bonds, and on the equity side, private equity and or venture capital, where younger companies can privately sell stakes to investors. And there is public equity in the form of issuing stock, an IPO, initial public offering, or subsequent offering, SEO. Banks offer investment advice and have investment professionals, teams, departments and branches. Indeed, there are banks which exist exclusively for this purpose. Bank involvement in investment extends to providing direct and indirect stock trading services. And finally, for customers with enough money, there are services characterised as private banking and wealth management. Collectively, this spans much of what the banking sector does as a whole. Indeed, all of this activity fits under the umbrella title of full service banking. Now, in order to nail things down and provide a FinTech frame of reference, so to speak, we can make a simplifying observation within and between the categories shown here. Essentially, everything that happens in financial services involves doing something with money. Either we are transferring money and capital, raising money and capital, or we are investing money and capital. This categorization proves a useful foundation upon which we may visualize the primary components of FinTech, and that is what we shall do in the next video.